Inflation's the highest it's been in 40 years. Stock markets around the world are down at least partially because of this inflation. As investors, how are we supposed to protect ourselves against this? Well, in today's video, I'm going to teach you what you need to know to protect your portfolio against inflation. Hey everybody, I'm James Knoll, founder of Root Financial Partners, and I'm here to teach you what you need to know to create a secure retirement. So as investors, what are we to do about inflation? We can start to see the impact that this is having on us when we go to the gas station, when we go to the grocery store, when we look to buy new cars, new homes, new clothes, whatever it is, inflation is clearly having an impact on the way that we live our lives. Now, as investors, we also have concerns of what does this mean for my portfolio? Yes, the standard of living is getting higher, or the cost of living is getting higher, but how do we protect our portfolios? Well, number one, the first thing that you need to know when it comes to protecting your portfolio against inflation is this. Inflation is always one of the main reasons that we're investing. Take a look at this chart here. What this chart is showing you is since 1980, $1 in that year, what the impact of inflation would have been upon the purchasing power of that dollar. So as you can see here in 1980, if you had one single dollar right here, over the next 41 years, the value of that dollar has dropped by 70%, meaning you have lost 70% of your purchasing power by simply keeping that dollar as a dollar, keeping that dollar in cash. So as investors, this is why we invest. Not just recently, where inflation levels have been elevated and certainly higher than they've been any time in the past 40 years, but really indefinitely. This is why we're investing. We are trying to see how can we maintain not the value of our money, but the value of our purchasing power. How can we continue to enhance our purchasing power so that 5 years, 10 years, 20 years, 30 years from today, our money can go further and further and further, even as the cost of goods and products that we buy goes up and up and up. Well, here's the good news. This looks depressing. The value of $1 has been cut in not half, but cut by 70%. Here's how investing can fix that. Let's just start with the S&P 500 as an example. So about 500 of the biggest companies in the United States of America, if you take a look at the S&P 500, and if we look at $1 invested in the S&P 500 in 1980, well, as we know, the S&P 500, it goes up and down and up and down and up and down, but over that time period, by the end of 2021, $1 invested in the S&P 500 in 1980 has turned into over $116 at the end of 2021. So there is good news here, is as investors, as we are investing our dollars and making those dollars worth more and more and more dollars, that is helping us to offset the impact of inflation. Here's the problem. As investors, and this is perfectly natural, we are so focused on these moments right here. We're so focused on the volatility, and we're so focused on look what's happening because of inflation in the short term, or look what's happening because of issues around the world or geopolitical risks or economic risks. We're so focused on these moments right here that we lose sight of the fact that over time, investing in the market has been the most, in my opinion, tremendous way of outpacing inflation with little to no effort over that time period. So number one, how do you protect against inflation? Well, first and foremost, you realize investing is always done with the goal of exceeding inflation over time. One of the things that you have to do, though, is zoom out. In the short term, we get so focused right here, and that's all we can think about, and we turn on the news, and this is all the news is talking about. But over the long term, look at what that market has done. Look at what just the S&P 500 has done when you compound it over years and years and years. So as you zoom out, you start to get a clear picture of investing helps us to outpace and exceed inflation so that yes, the cost of everything is more expensive, but our dollars are also more valuable because they've been grown through a proper investment philosophy. Number two, the second thing you can do to protect against inflation is this. Understand that every single decision you make as to how to invest or save your money comes with risk. There is this philosophy or almost this thought that, okay, cash is risk-free, stocks are very risky, and so to protect, we go more into cash. That couldn't be further from the truth. In the short term, absolutely. Cash carries very little risk. $1 today is going to be worth $1 tomorrow if it's in cash. $1 in stocks today, probably not going to be worth $1 in stocks tomorrow. It's probably going to be higher or lower. So in the short term, cash is it does not have a lot of risk, that is very true. But as you expand your time horizon, cash becomes very risky. As we saw from that chart before, $1 in cash in 1980 is worth about 30 cents today. Now, that doesn't happen overnight. It doesn't seem that $1 doesn't become worth $30 or 30 cents overnight, but there's that slow, gradual deterioration of your purchasing power. So in the short term, there's not a whole lot of risk with cash. In the long term, there's tremendous risk to cash. You are guaranteed almost to lose your purchasing power over time. Contrast that with stocks. In the short term, stocks are very risky. Stocks can go up a whole bunch or down a whole bunch when you're looking at a shorter time horizon. But as you zoom out, as you look at 10, 15, 20 plus years, stocks are incredibly consistent in terms of the positive outcomes that they generate for investors. And by the way, stocks aren't the only asset that you can invest in. You can invest in public equities, which is what the S&P 500 is, a collection of the 500 biggest equities or biggest stocks and companies in the United States. You can invest in real estate. You can invest in private companies. You can invest in anything, really, as long as you're investing in something where the value is going up over time. Any of those things in the short term can be considered very risky, but over time, if you invest the right way and you stay diversified, you have a tremendous chance of having not just a positive outcome, but an incredibly successful positive outcome over time. So understand that no investment is without risk. Cash carries just as much risk as stocks do. I would argue even more so, but it's not until you look at a longer time horizon until that risk shows up. And the third thing that you need to do is you need to plan accordingly. You need to take this information about the risk of cash or stocks or anything in between and make sure that you are tailoring a portfolio to your particular situation. Let's look at a couple of examples. Maybe you're age 45 and you want to retire at 65. Well, inflation is a risk. I'm not going to discount that. But that risk of inflation isn't necessarily with your investments. You're not using your investments most likely to pay for groceries and to pay for housing and to pay for clothing and fuel and everything that you spend money on. You're most likely using your salary to do so. So how do you offset inflation in the short term? Well, ideally, you're doing something to increase your income. Sure, easier said than done in many cases, but increasing your income from your salary, that's the only thing that's going to really help you to protect against inflation in the short term. What that means is your portfolio needs to be positioned to offset the risk of inflation in the long term. And again, in the short term, inflation can cause a lot of ups and downs in your portfolio. That's absolutely the case. But over time, investing in companies, investing in real estate, investing in things that grow is the best possible thing that you can do to protect against inflation over time, which is really where the true risk of inflation lies. Yes, it hurts to go to the gas station today, and yes, it hurts to go to the grocery store today, and yes, it hurts to spend more money on things that haven't cost this much even just a year ago or 2 years ago or 3 years ago. But where it really hurts and where it can really be devastating is when you compound that for years and years and years. So the more you can invest for growth, the more you're eliminating that long-term risk, or at least the more you're offsetting that long-term risk of inflation deteriorating your standard of living 10, 20, 30 plus years in the future. So if you don't need your portfolio today, if you're still growing your assets, the best thing you can do is to offset that risk in the future. Now, maybe you're already 65 and you're saying, James, that sounds good. And if I had 20 more years to go, easy enough, but I need to live on my portfolio. I need this money to live on. Go back to step number 2. Every investment has risk, and also every investment has value. Cash, for example, not a tremendous amount of value to you if you're going to let it sit there for 20 or 30 years. But in the short term, it can have tremendous value. And you should have something that is risk-free in the short term, something that is stable, something that you can depend upon. So as you're pulling money out of your portfolio to live on, what you have is you have options. You have some assets that are designed to protect against volatility and uncertainty and the ups and downs in the market today. And you have other assets that are designed to protect against the erosion of your dollar, the erosion of your purchasing power over time. And by structuring a portfolio, what you want to be able to do is have the right balance and the right mix of those assets so that you can pull money from your portfolio as needed, knowing that you almost have different buckets or different options to choose from so that you can maintain your standard of living even as the cost of that standard of living increases. This, by the way, can be the risk of certain pension options or annuity options where they seem like a really healthy amount of money today. And we say, okay, we need to live on this much money today. My pension or my annuity is going to generate this much. So it's going to come really close to meeting all my needs. Well, a lot of those pensions, a lot of those annuities, they don't have cost of living adjustments built in, which if inflation's really low isn't as big of a deal. But if inflation's going higher and higher and higher, and your pension or your annuity is generating a level of income that's completely flat, the delta or the difference between how much of your income needs to come from your portfolio versus how much is coming from your pension or your annuity, that's starting to widen, which is putting more and more and more pressure on your portfolio. This is just kind of a side note to say that as you're considering a retirement plan and as you're considering an income plan to generate the income needed to support yourself, make sure you are factoring inflation into that. It's not just current income today that we need to be protected with. We need a plan for that income to rise over time. So at the end of the day, in summary, how do you invest in light of inflation? Well, understand that you're always investing in light of inflation. Inflation is the thing that we're constantly trying to outperform to ensure that we're able to maintain and exceed our standard of living in the future. So having a plan for how you allocate your portfolio and how you allocate that portfolio considering your other income options is crucial to ensuring that your portfolio is able to generate income for you today and in the future, even after inflation's taken its toll. If you want more information about how can you generate a portfolio or financial plan to ensure that you're not going to run out of money, be sure to check out this video above. Thanks for watching. This is James Knoll with Root Financial Partners. If you enjoyed this video, please be sure to share it with someone else who you think would benefit from this information. And also, please be sure to like and subscribe for more content just like this. Finally, if you'd like to see how we help clients create a secure retirement, be sure to check out our website at rootfinancialpartners.com.